In this video, we're going to be taking a look at precious metals like gold and silver, as well as cryptocurrencies such as Bitcoin and Ethereum. We're also going to be looking at the stock market as well, looking at various charts and analysis of those specific assets. Now, before going into this, I need to mention this is not financial advice. If you're seeking financial advice, it's best to talk to a financial advisor when making any investment decision. I am not a financial advisor. This is not financial advice. So to get that out of the way, let's first peek into the price of gold right now. And the price of gold, as we see right here, is just about $1,900. The price of silver is $27 per ounce. We're using goldprice.org as a simple website to give us some stats about it, some historical data, as well as the current price. As you can see, this is in ounces right here. So if we scroll down, we can also see a chart of gold. This is a daily chart. And so this will tell us the data each day with a candlestick right here. So the green is a buying day, red is a selling day. And as we can scroll back, we can see historical data right now showing August in 2020. We had all-time highs of $2,000, $2,080 almost. And then it came back down here to about the below the $1,700 range, $1,690 or so. And then it did a double bottom in March of 2021, and then it came back up. When we scroll back, we can see what happened during the whole crash that we had back in 2020, or the big pullback, as you may call it. As you may recall, it did a huge dip. Every single asset pretty much did a big drop in price. And it came all the way down to about $1,478. Then recovering very well, going to over $2,000. And then now we're coming back up. It looks like we just did a double bottom in March and April. And then coming back up from that double bottom, we are now just a couple months from that bottom and are going from 1,700, below 1,700 to just below 19. We've even pierced it a couple times. And as you can see, we may be breaking through the 19. 19 right now, 1,900 is acting as resistance, it looks like. And if we can break through that resistance, we can continue on up to other points of resistance. Most likely we're going to hit other resistance spots beyond the 1900 level if we can break through it. As you can see, we have 1960 right here. This is acting as resistance before. And then beyond that, we have a little bit at about $2,000. That's a pretty big round number resistance that we have there as well. So is gold going to continue to rise? Well, many would say that it could, because it's very likely we're going to be continuing in inflation and be at some pretty large inflation numbers because of all this stimulus money and all of this excess spending and printing of the dollars. Now, this is a chart of gold here. We can also move it over to other assets as well. I'm just going to see if I can pull up silver. Let's see if we have, here we go. So now we can also look at silver. Silver has been trying to break through this for a little bit of time now. Since July of 2020, we've had this 27 area. $27 per ounce has been a bit of a challenge to break through that. We've done it a few days, but now it's still trying hard to get past that. Like gold, silver is also has been known to protect yourself in during times of inflation and to hedge against the US dollar. Now, gold and silver could be a wise decision to make to accumulate more of if we're going to be having greater inflation. Now, there's been a lot of talk about not having so much inflation, and the Fed is not is trying to keep that low. But as we look around, we're seeing the price of gas go up. We're seeing other prices of just about anything else, household products and everything has been on the rise. And services have been increasing. Everything that needs gas, of course, will need to be increasing their prices. As prices rise, then could be experiencing deeper and much bigger amounts of inflation. As prices rise, then historically gold can be a pretty good asset to put your dollars into. If the dollar is declining, gold and silver here could be rising and could be a good hedge against those inflationary measures that take place. Devaluing the paper dollar, the fiat currency. Do you really want to keep those paper dollars when we're just printing trillions and trillions of dollars more? It's just been cranked out like a printing press throughout the decades, but especially this last year, it's been absurd. And so investing in something like gold and silver throughout the years has been known and has been said to be a good thing to do to offset inflation and to put something in a store of value that has for thousands, over 6,000 years, has always been worth something throughout mankind. We've always had gold and silver available, and we've always had it, as a somewhat of a store of value of some level of value, meaning something so that we can trade it for goods and services, for food, etc. So looking at these charts here, is it a wise decision to invest in gold and silver? Well, based on the charts, you may want to be more bullish about that depending on your style. Also, the fundamentals might suggest that this might be a good decision as well. And this is in goldprice.org. We can also look at the charts in other charting services we have to look at technical indicators. These are just looking at candlesticks. Right now, we're seeing resistance. Okay, so if we can break through this, we can just continue on up. If we have a couple days beyond this point, so we've had a lot of times where we've just struggled with that 28 number. If we can break through the 28 and continue to rise beyond the 28, that could be a bullish indicator suggesting that it's going to continue going up. And this is silver here. Now moving on, we have big charts, and currently this is a stock called WMT, which is Walmart. This is something that I had up, and you can use this style of charting to look at other assets as well. You can look at stocks. You can also look at ETFs. One thing we might want to see is GLD. This is an ETF for gold, and this allows you to trade on the stock exchange for gold. As we can see here, it dropped pretty significantly as an ETF here just a couple days ago. And when it did that, it pulled back down to a technical indicator called Williams %R. It dropped pretty low on that. And this could suggest that this is very similar to other technical indicators, similar to technical indicators like RSI. It shows us if there's a lot of selling or a lot of buying. When it's low, it suggests a lot of selling. So there's a lot of selling here. And when it pulls back, this is a moving average right here. This is about the 30-day moving average. This is the 7-day moving average. And when it's pulling back down here, this would be an interesting time to accumulate more. When it's pulling down to the 30-day, this is also oftentimes a good time to buy more of something that you want to buy for the long term. Now, in this case, we're just looking at the chart and how it has been trading on a daily basis. If we're wanting it to move up and we're going to be trading to make a bullish trade, we might want to wait for when it breaks above the 7-day a little bit more and then breaks through this resistance here. We have volume as well, showing a lot of buying that went on a few weeks ago back here in this spot. This is a really big buy volume indicator, and that was showing that this would be a good time that a lot of people were getting in right here. Now, is this going to continue to go up? Time will tell. Nobody has a crystal ball, but this is something that you can also use to get another picture of what the ETF, the gold ETF, is doing. You may want to put some cash in here if you have retirement accounts, or if there's money in the accounts that you have that you cannot get out of because of retirement issues. So if you're having money that's stuck in your retirement account and you can't access that, then you can still acquire assets like gold and silver through ETFs. And this is all done in this gold shares ETF right here, GLD. This is something you can pick up with Schwab or E-Trade or Fidelity or something like that, some kind of retirement custodian that you might have. You can get and accumulate shares with like a Roth IRA or a traditional IRA or a SEP or something like that. This can be a good idea to pick up when you are wanting to accumulate gold and silver, if you're wanting to hedge against the dollar and you believe this is a good store of value. You can always put money into this ETF and it will follow along with how the price of that asset is doing, what the price of the bullion, the raw gold is trading at. This will follow along that same in the same path to give you an estimate of exactly what that's doing. And there's a lot of different theories about how people view this. Some people are a little bit unsure about this because they want to have the gold they can hold, putting it in a safe place or in a place nearby, like in a local vault or something like that. That's kind of someone else's own personal preference, but this here as an ETF will let you have it backed by gold. So buying this ETF is, they claim that they have everything backed by gold through this ETF. They actually have the physical gold, I believe. So that's something that you may want to do some further investigation on. And if you're wanting to increase your assets and have that trail the same price of gold, an ETF might be an option if your money's stuck in the retirement account. If your money's not stuck in a retirement account, or you can move that, you can still transfer it from an existing IRA to a gold IRA through other services like we have in the videos of this channel, of course, as well. But GLD here is something that I've been following for a while. It's something to look into. And as you can see, it's following along the price of gold, and there have been a little bit of differences. Let's see, I'm going to pull this up again here real quick. So yeah, it dropped here and it dropped here. So it looks like it's following almost exactly like the same way the price of gold is. So if we take this back, let's say take back a decade and see exactly what gold has been doing. You know, we had, was this 2012, 2011, we had it spike up and then come back down. And then now it's really doing well. Let's pull this back and see if we can see a bigger chart like that. I'll do a all-time chart, 2011. Yeah, we had it in here as well with I'm gonna have to refresh this to get an accurate chart here. Try to get a better one so we can see exactly what it's been doing. So I'm going to do an all-time chart. I believe we have gold here. Yeah, there we go. So 2011, when it got to about 1,800 an ounce, it was doing this. And then, yeah, we have it spike up right now. So this is a little more of a better way of looking at it through a bird's eye view of exactly what gold has been doing when we take it back. I have it in all-time data, so I could scroll all the way back if I really wanted to, back to 1975 and see all this as well. But I'm just going to zoom in to the last 10 or 11 years. And you can see we're breaking all-time highs, historic highs that we've ever had with gold. We've pierced that. We've continued to establish some sort of comfortable pricing, and the price has come down a little bit, but we've really established those levels. This now has become what's known as support. So this kind of bounced off the past time. It was, this former all-time high about 1700. That now became support, and it just bounced right off of there. So it could be going higher, or it could be acting as like a channel right here, and it could be kind of trading in this little channel for a little bit of time. We'll see if it does go higher. And when it does that, whatever it's doing, whether it be gold bullion you can invest in, or this ETF, there's other ways you can start to have some of your own and benefit from this asset appreciation, provided that it does continue to go up. And many believe that gold is a good store of value and will hedge against the US dollar, hedge against the inflation as well. So we'll see with the depreciation of the dollar, this might be something that that could be good for you. Now, when we can also look at the SLV iShares ETF, which is for silver. You can see here it came down to touch the 30-day moving average. This is oftentimes a good place to be at to buy more of something. So with stocks, when they come down to the 30-day moving average, some traders will find that a good place to load up more of, calling it a correction when it's coming back to just retest to then load up a little bit more of that asset. Now, it touched this, and then it's coming back here to its resistance. This as well could break through. We could be seeing some new all-time highs this year, even with silver as well. So we can go back to, let's say, a decade and then see where it's been at. And silver had been really high. This was 2011 when it was all the way up to 40. And now it's still kind of struggling around this 26 area. But it's really, it broke through 24, and it could be going much higher. There's a lot of different schools of thought with silver and gold when you compare the two. Many times you'll hear that in terms of an asset that performs and the potential of it to perform greater, there could be a greater potential of silver increasing its value over the coming years than gold. Gold, of course, is about $1,900. $1,900 is a lot of money. And how much more will it be increasing by? Will it 2x or 4x? Possibly. That's very likely it could. Could it 10x? Meaning, could it get you 10 times its value? Could it go to $20,000? Well, perhaps, but it could take a long time to get there. It's hard to imagine that silver would do less than gold would. So I could see, for example, if silver did, if silver went up to $100 per ounce, then that could probably be a scenario in which silver could be trading at, and that would be a 4x of its current value. With gold, if it 4 times its current value at around $8,000, that would be quite a big jump for gold. For silver, it may not be as much of a hurdle to get there. So something to keep in mind, and something to read up on as well in terms of the potential growth for assets like gold and silver. Now, moving along, there are other assets that you can take a look at. One might be Bitcoin, and by looking at Bitcoin, there's obviously places like Coinbase to trade and to accumulate some Bitcoin in that platform. But if you're not comfortable using Coinbase, it can be pretty simple to set up, and it's definitely worth taking a look at and seeing if you can move some money to get there to accumulate assets like cryptocurrency, Bitcoin, other cryptos like that. Coinbase is based in the US and a very good place to put your money in for security purposes. I mean, it's pretty well the most established one out there, so might be something that you'd feel comfortable with. But if you can't move any cash at the moment, or don't have any cash available to invest in cryptocurrencies, or want to do bigger purchases that you don't currently have the capital to purchase, but you do have retirement accounts or have something that's built up that you can actively trade, then you may want to consider Grayscale's trust funds that they have for Bitcoin. They have them for Ethereum, and they also have other cryptos as well in their trust funds. And these are all backed in their trust funds, meaning they actively have accumulated these cryptos and they do have them, which of course is worth looking into and doing your homework and research before picking this up. But this can be a great way of accumulating cryptos that you may not be able to otherwise with your retirement portfolio. So things like a Roth IRA, a SAP, a 401k possibly, or a solo 401k, other IRA versions or SEPs. You can do that with this particular ticker through an ETF. You can actually start getting this through a normal stock exchange. So your typical trading brokerage, you can pick this up and put it in your IRA. So this is something to look at because it could be an asset you might want to hold for the long term, like the S&P 500 or like something like that. There's a lot of theories, of course, out there, and some people may think it's going to zero, but others may have a very long-term bullish stance on cryptocurrency. And if you do so, then you may want to start accumulating some and also putting some tucked away in a retirement portfolio. So this is the main one that Grayscale has, the Bitcoin one, which is Grayscale Bitcoin Trust. It's tied to Bitcoin, and of course it's a lot cheaper than buying a Bitcoin as well. Not that you would have to buy a Bitcoin, because you can open up a Coinbase account and just get fractionalized amounts of that, meaning you could buy $1 worth of Bitcoin, you can buy $100 worth of Bitcoin. You don't have to buy one whole Bitcoin in a Coinbase account or other kinds of crypto accounts. But with GBTC, you can use this ticker to actually pick up some Bitcoin in a Bitcoin trust that you can get with your retirement account. So definitely worth looking at and considering your options there. You can see that it is tied to the charting of Bitcoin. It's of course gone down. The one thing that's a little bit different about this is that because Bitcoin moves throughout the weekend and throughout all hours of the day and night, then this is publicly traded, so it's not actually moving at those hours. So Bitcoin might, let's say, go down 10%, and then if it goes back up 10% by the time this opens, then you may not have that opportunity to buy it at a 10% reduction at a lower price. You may actually not be able to get in at that moment because you have to wait until the market opens. And same as if it were to go up, you couldn't actually trade it at that specific time if it's not within the window of the stock market. So this trades on the stock market time, and trades like pretty much any traditional ETF or stock. Has a ticker symbol. You can look it up, and it follows the Bitcoin price. As you can see right now, it's pulled back a lot. This is a 7-day moving average, and well below the 30-day moving average. Some may find this an appropriate time to accumulate more. And if you have a very long-term bullish stance on Bitcoin, it might be a great time to pick some up because it is much lower than it had been. Of course, it's a lot higher than it's been in the last few years as well. But if you look at the last few months, it's gone up all the way here to 58, which would also be something completely different if you looked at the Bitcoin chart, which we'll pull up in a second. But here in this ETF, it of course went to all the way up to 58, and kind of going at the all-time, or bouncing around the resistance point of 54, and then dropping all the way down here. Looks like today's low is 28.50, so almost half of that price. So could be good to pick it up and get some more. So this is, of course, Bitcoin. We also have ETH, which is Ethereum, and that's also done by Grayscale. Grayscale is the place that does the Bitcoin Trust and the Ethereum Trust, and it trades on the market as well. So this is the exact same charting as you'll see with Ethereum. It follows along the Ethereum price as well. So you can pick it up at lower levels when it dips down. That's something that you might want to consider. Today's low is 26.25, so could be a good time to accumulate more. As you can see, it's been at higher levels all the way up to around $42. And similar to the last chart, it publicly traded and traded on the times that the market trades. So you might not be able to get in and trade if it's out of market hours. So with Ethereum, it'll trade throughout the night, anytime, all day, just like Bitcoin. So if the asset is going up or down and it's outside of market hours, you wouldn't be able to pick this up in the trust. So you might want to do a Coinbase account if that was your concern about picking it up at specific times. But in this case, this could be another good way to add some cryptocurrency to your portfolio. Ethereum is the second largest cryptocurrency next to Bitcoin, something that you might want to start establishing and accumulating, because the price for this asset may be much, much higher in the years to come as there's more projects that are being added to the Ethereum network. This is different than Bitcoin in many ways. Definitely worth looking up, doing your homework on if you haven't already, because this could be making some really big changes. And the price for this could be going up a lot as well. And unlike Bitcoin, Ethereum does have a creator that's known, and unlike the Bitcoin story and the Satoshi Nakamoto mysterious man that nobody really knows, Ethereum does have a creator and group that's well known. They have a lot of projects coming out, and they can have a lot more advantages, and they're very different from each other as well, which you can hear more about. So Ethereum could be something else to accumulate. One idea that you could be doing is dollar cost averaging. When you dollar cost average, that means you buy at a specific time. It can be a set time. That's, let's say, every first of the month. So every first of the month, you could buy at a certain time, and that way, if the cost is really high when you get in, and then the next month it drops really low, then you average that price. So let's say you buy at the all-time high, and the all-time high is $10,000, and then it drops 50%, and now it's at $5,000. Of course, that's way higher than it is right now, but if it's $10,000 when you buy, and then you buy again and it's at $5,000, then your average cost would be right in the middle at $7,500. And as long as you're dollar cost averaging at the exact same amount of purchases, so the exact same purchase amount, so let's say your amount is $1,000 every single time, then that's a very good traditional approach, a long-term approach that many stock investors have been doing. Many portfolio and retirement investors swear by this investing approach, because there's really no crystal ball. Let's face it, nobody can see directly into the future and tell you exactly what's going on. So by dollar cost averaging, you can see, you can kind of control it a little bit better, because no matter what it does, you're going to be getting in, and that way it'll average it out. And when it does really well, then it'll average that out, and you can still capitalize on all those gains because you bought at different prices throughout the whole length of your accumulation. So dollar cost averaging is a very good idea if you want to start accumulating, whether it be Bitcoin, Ethereum, or or the S&P 500, the stock market, which we'll take a look at in a second. And right here, this is the price of CoinMarketCap. This is the chart of CoinMarketCap, which shows the price for cryptocurrencies like Bitcoin, Ethereum, and the other major cryptocurrencies. We have others as well, like Cardano, XRP, and different coins like the Binance coin that's been introduced as well. So with Bitcoin, its total market cap here is $630 billion, which is a lot, but it's definitely, it's come down from where it has been. The price is at $33,000 right now. This has dropped almost half of its all-time high, which was just established not too long ago. We'll take a closer look at that as well. And then Ethereum at 2,600, and its market cap is about half, actually more than half, the market cap of Bitcoin at $301 billion. So by clicking into Bitcoin here, we can start seeing the chart in CoinMarketCap. And I'll just go back into 3 months, or even, well, let's do 3 months. As you can see, it came up all the way to $64,000, and then it's now down to $33,000. So look at that. It's gone down half of what it was just a couple months ago. So it was back in April, and now we're in June. So yeah, just a few months ago, it's significantly dropped. Now, this will also, the price will roughly follow along the same price that we're looking back here at the Grayscale ticker here as well. So Grayscale Bitcoin Trust, we can check that out, and then we can check this out, let's say on a 7-day basis. Change this up. I'll do 1 month just to see the comparison real quick. So we have 1 month where it's up here, $48, and down here at $29. Over here, let's do 1 month as well. It's up around 60,000 early May, just 1 month ago, and then all the way down here, 33. So that's pretty much half of where it was. Here, $48, and down here about $29. That's half as well, almost half. Not quite, but it's getting there. And we'll see what it does. But in the long term, no matter what you've done over the history of Bitcoin, no matter when you have bought, you can recover that even if you bought at the all-time highs. Every all-time high that there's been an all-time high of it with Bitcoin, you can still recover that money and make gains from those all-time highs, even when you bought at all-time highs. So if you bought at, let's say, $30,000 when that was the all-time high, or $20,000 when that was the all-time high, and then it crashed to $4,000, even if you bought at $20,000, you would have lost a lot of money then. But as long as you kept holding, then you would still be ahead. And I'll show you real quick. Do like a 2-year window here. Actually, I'll pull this up here, year to date. And we can see, once we get this loaded, year to date, how it's changed. It's fluctuated, it's volatile, it's extremely volatile. Let's see here. Oh, year to date, I'll do all, here we go. Yeah, you can see it's extremely volatile. But even when it's volatile, let's see, 2017, if you bought here, this would be crazy. You know, as a rule of thumb, you don't want to buy at an all-time high. But let's say you did. Let's say you did and you lost and you felt terrible because you just now, you know, after buying at $20,000, it came down to $3,000. So you're freaking out. Well, that was January 2018. Let's see, January of 2019. It's coming back at 12,000. And then January of 2021. It's at 19,000. So what was that? 18, 19, 20, 4 years? All-time high. And yeah. So, excuse me, it was a 4-year window. This is why I'm not a financial advisor. 4-year window of time. That's a decent amount of time to wait. 19, 20. So 1 year here, 2 years here, 3 years goes by. Boom. Now year 4. Okay. Year 4, let's say year 4, you bought all at the complete all-time high. Year 4, boom, there you are. You've just broken even, which that sucks. But right after you've tripled your money. If you would have sold, or the value of it at the time has 3x'd. Boom. So you went from here. If you would have waited, 4 years, long time to wait, but not that long to triple your money. If you want to triple your money, really not too long to triple it. Now we're coming back down. Are we resembling previous trends? Previous times we've come down? Maybe, possibly. But coming back down, and then is it a good time to buy now? You be the judge. I'm not offering financial advice. But take a look for yourself, see what you think. And throughout time, I don't know where I found I found a quote about buying at all-time highs. And it was something like a few years. Maybe it was 4 years. It was probably 4 years. As we can see here, if we bought, it would take us 4 years to get that back. But there's other times, though, where you're not buying at the all-time high, but you're still buying at a pretty big high. And it takes a little while. But doesn't take that long in comparison. And then when you do wait, boom, you've made some huge improvements. You made some huge gains from where you bought. And then, of course, you can get absolutely ridiculous and then see what happens when you buy at the lows. And it's hard to time the market. But if you're a firm believer in cryptocurrency, then it doesn't really matter at what point it drops to. If you're still buying those lows, then you're still going to be up even more when you buy those lows and it goes back up and then some. So considering where the lows are and the highs are, it's hard to time. It's hard to predict exactly where the top is and exactly where the bottom is. But that's why you might consider dollar cost averaging, because dollar cost averaging allows you to get in at any time of the market as long as you're consistent with that time that you're dollar cost averaging. It could be every single week. It could be every Friday. It could be every other week. It could be once a month. It could be once a quarter. But as long as you're making those consistent accumulations, then you could be making some interesting and massive accumulations to your wealth and your portfolio over the long run. That is, of course, if you're doing crypto, if you're doing Bitcoin, there are risks and there's no guarantee where it's going to go. So I'm not a financial advisor. As I've said, I'm not offering financial advice. But assuming that it goes up, then that can be a very strategic and smart move. S&P 500, that's another thing Warren Buffett talks about all the time. Dollar cost average in the S&P 500, and you can't go wrong there, historically speaking. Is the S&P 500 going to go away completely? Well, who could say that? Probably not, but there's no guarantees. And most likely it's a very conservative bet. We have companies, and we'll hopefully always have thriving companies that do really well in the S&P 500 that allow us to make great consistent gains every single year. But is the S&P 500 in a bubble? That could be debatable, but it seems like it keeps on hitting new highs and new highs and new highs, and we haven't had a correction in a long time, or really a recession or any kind of major pullback consistently outside of the V-shaped pullback that we've had in 2020. But we can come over here, we can take a look at the S&P. There's a couple ways of looking at S&P. S&P or SPY, that's one that you might want to consider. It is a ETF, the S&P ETF Trust. Then there's also SPX that you can look up too. It's the S&P 500 index. So the ETF is nice when you want to get an index fund of the S&P 500. And this follows along. It's very similar to the Bitcoin ETF that we looked at and how that was trailing along the same price of Bitcoin. And the SPY fund, that allows you to buy it, of course, cheaper than the S&P 500, but it follows along the S&P 500. So we can look at SPY, we can look at SPX, but it's about the same chart. However, of course, S&P 500, that's the full-on S&P index, which is a lot more expensive, of course. So $4,226. Definitely doing very well, doing very strong, continuing to make new all-time highs. Is this a good investment in the next couple of years? Do you think that this is going to continue to go up in next year and the year after that and the year after that? Is it always going to continue going up? Time will tell. But how long have we been going up for? Let's take it back a decade. Let's see. So we had, of course, this pullback, this V-shaped recovery in 2020 because of the big thing that happened. And since then, we've just been going absolutely crazy. But before then, when we had the other market crash, let's see, 1 decade. For the most part, we've been doing pretty good. Let's do all data. 2008 is when we had a pretty significant one. Here's 2008, and then boom, dropped really hard. And then we recovered. It took a few years, but then we recovered. But look at what it's been doing. So ever since 1979, went up here. We've had, of course, different corrections, pullbacks, recessions. Boom, crashes really hard from the dot-com. This is 2001 dot-com crash. Took a couple years, 1, 2, 3, 4, all the way to the bottom. Then it recovered. Took about another 4 years or so. And then boom, crashed really hard. And then to recover from that, 1, 2, 3, 4, 5 years or so. And then ever since that, we've just been going really strong. We've had a few pullbacks here, some V-shaped recoveries, and extremely strong right now. Extremely strong. So is it going to continue doing this? That would be amazing. It would be record-breaking, and it has been breaking records, so maybe it will still continue to break records. But how much longer? How sustainable is this kind of trend? We'll see. We will see. But it doesn't seem like it can always be doing this forever. So depending on your philosophy, what you're wanting to do, it may be good to consider other assets like the ones we discussed. Now, with that aside, you can still dollar cost average in the S&P 500 and still feel comfortable about buying in, knowing that you'll be buying in a little bit consistently, no matter what it does. And so that those huge gains, huge losses, those huge losses will be kind of offset because you'll still be buying in. So maybe when it drops a lot, you might want to spend more money, invest more money to offset any losses that you might have had. But when you dollar cost average, then you'll be continue to build that asset, and your portfolio will get stronger and bigger and do well later on. And if you're comfortable holding it for decades, then it doesn't really matter too much what it does in the near-term future. So S&P 500 is one of those investments that investors like Warren Buffett has sworn by. That if you don't know what you're doing at all, then you can't go wrong doing this. Now, one thing that's interesting about this, it's dollar cost averaging into the S&P 500. It sounds really simple. It sounds like anybody could do it, and that's true. You pretty much could do it. It doesn't take a lot of thinking. However, most people don't because of many reasons, but fear could be one of them. Unfortunately, it seems like there's a lot more comfort in just not thinking about it and letting other people handle people's money. So we work all these years to let other people manage the direction of our future and our retirement, and that just doesn't seem very wise to give complete control of everything you're doing in your future to someone else at a pretty hefty price tag. If you really look into the fees, it's quite a lot. So the S&P 500 is a very inexpensive way comparatively. It's fairly a very good way to go, fairly inexpensive, and doesn't have all those fees when you're doing something like the SPY to invest in the S&P 500. The other one you can do is the VOO. This is the Vanguard S&P 500. And this is a great one because you're still getting a little bit of the yield that you get, the S&P, meaning that little dividend. But you're also saving a decent amount in fees. It's a nice savings from the traditional S&P or the SPY fund. The VOO, the Vanguard S&P 500 ETF, doesn't have as many fees there to manage that for you. So when you compound that over the years, it can definitely add up, and it can be definitely a good savings for you and just go back more into your retirement portfolio. So it's a nice one to look into. Now, one thing to consider too about investing, if you're not familiar with stocks and you just want to keep it simple, this could be a good approach. But if you're wanting to add a few stocks to your portfolio, one thing to consider is dividends and dividend paying stocks, especially the blue chip companies that have been around for a really long time. One of which, well, you can look into quite a few. Coca-Cola is one that Warren Buffett has, of course, done very well with. I believe it was the first one that he made his money from. And it was the first one that he really took off with. So this is something that he keeps in Berkshire Hathaway in his main portfolio. It's one of the top, I want to say top 3. It could be the top 5, could be number 4 or so. Apple being up there as well as Bank of America. And you have Coca-Cola that's always been in his portfolio. So Coke has been, it's a good brand. It's been around for a while. It does have a dividend right now. It pays 3%. So that means if you bought one share, let's say you buy, for the sake of simple math, you buy 2 shares. If you buy 2 shares, that would be over $100, and you'd be making 3%. So you'd get $3 every year. That's going to be broken out in four different times, or four quarters. It will be split. So each quarter you'll get your dividend. You can reinvest your dividend into getting more Coca-Cola, more shares of that, or you can put that aside and keep that as cash in your portfolio. But when you have a dividend like this, then it definitely is a nice little extra bonus for you. And no matter what this does, you'll still be getting your dividend. So it's a nice little assurance that you'll be getting something for that. And what's really nice to think about right now is what kind of savings account or what kind of checking account can you find out there right now that pays you this, that gives you this no matter what. 3% is what you'll be getting here. Last time I checked, the highest yielding savings or checkings accounts will pay maybe 1%. So this could be something to consider, and especially this could be more of an aggressive tactic, and it's definitely not something I recommend for everyone, and I'm not giving financial advice by any means anyway. So just giving out a strategy to think about is if you were to look at your mortgage and refinance and look at what you're paying for whatever your loan principal is, and are you wanting to really pay down your house more so that you can save that interest rate that you have for your home? When if you were to, let's say, instead of putting all your money into your house, you put some money into a stock, especially stocks with dividends. Well, let's say you could refinance and you can get your refinance down to, let's say, 2.75%, or that would be, it may sound kind of crazy, but 2.5%, something like that. And then you invest and you have a dividend yield of a 3%. Well, there's other benefits with paying interest for your house, like write-offs. But you have now, you could potentially make about the same in your dividend back than if you were to pay down your house. So this is just one dividend. There's other ones from companies that you've heard of for years, AT&T. So this is just like one example of a dividend, but check this out. We have another one. This one pays 7%. So if we're going to be thinking about the idea of, or the model of, whether or not I pay extra for my house to save my 3%-ish or 2 point something percent if you were to do a refinance or mortgage, if your concern, is that so that you don't have the interest rate, because nobody likes paying interest. But if you were an investor and just kind of flipped it and thought, well, what could I be getting instead of having to pay or to save from paying at this interest rate? Could I be making more? In this case, you could, because this is AT&T and they'll pay 7.15 at this amount if you were to buy in. It's actually dropped pretty good too. If you were to buy in now, you'd be getting 7.15%. There's no home loan or refinance that's that crazy. So, chances are if you have a mortgage, that's just something to look at in terms of a model. Definitely not a suggestion. You teach your own in terms of your strategy, and make sure you do your homework and do what's comfortable for you. But this is just another way of thinking that could make some things interesting to think about. Well, if I'm paying, let's say 3%, or let's say it's even 4%, then you could be making almost twice that amount. So, you make that money back and then some more just from a dividend. If this continues to go up, right now AT&T has had some trouble. I believe there was a deal with Discovery. There was like a merger. There is a potential dividend cut. They may be cutting their dividend next year to bring it down to 5%, but 5% is still really good. So there's not so much of a concern to me, but there's been a big concern in the idea of that happening, meaning a dividend cut happening, and people are not liking that maybe. So in turn, there's emotion and it's going down a bit. But if we can take the emotion out of the picture and look at it as a long-term investing perspective, then it's certainly dropped a lot. It might be a good idea to pick something up, especially if there's a dividend there. So that's one dividend. And there's also this as well, Chevron. We've all heard of Chevron as well. And they have a dividend as well that's about 5%. So you can find dividend stocks out there that that'll be around. They're not just a fly-by-night company or anything like that. They'll pay you as an investor to invest in them. So that's something that you might want to consider as ways to offset interest rates that you're paying, or just to accumulate into your portfolio some dividend stocks. Another stock you might want to look at is Disney. They've been doing a lot with their streaming platform. They don't have a dividend, but they're one of those really old school companies and long-term companies that will probably be doing some interesting things in the future too. It doesn't look like they're going to go away anytime soon. And then we have Apple as well, which is growing a lot. They do have a small dividend. That's one of the main stocks that Warren Buffett keeps in his portfolio. Not much of a dividend here, but it's a growth company and it'll probably be growing a lot. It's dropped to about $124 right now, but could be doing a lot in the next few years. And so there are companies like that you could want to consider or look into deeper to add to your portfolio and to see what happens in the near future with those companies, it's always good to take a look at and to watch, because as you get more familiarized with ticker symbols and investing and dollar cost averaging, you may want to feel comfortable enough to put some money into the actual stock market and start accumulating for long-term wealth. The main takeaway here is that whatever you're doing, you could be doing a lot of this stuff yourself and getting good returns. You know, if you have a big interest in the S&P or the overall market with the S&P 500, something like this could be way more advantageous to kind of handle things yourself, take control yourself, rather than just hoping that whatever you're doing with whatever form of investing that someone else is handling for you is working out. It's good to just look into those fees and to do a little bit of homework to see what your best possibilities are. So hope you enjoyed this video, and happy investing.